I guess it did. No, it didn't. Questions? All right. Let's talk about rental properties. So, I mean, we all pretty much know what rental properties is, right? Somebody else owns the property and it is rented out. For use by somebody else. Now, it might not necessarily just be real estate, it could also be personal property, right? So, any rental income received or accrued for the occupancy of rental of real estate or for the use of personal property. So you could rent out tools and equipment and stuff like that, right? Places like Lowe's and Ace Hardware, they do that kind of stuff all the time. There is some special treatment with regard to individuals who are in the real estate business. So ordinarily rental property is passive income. You're not really actively generating the income. You've got a piece of property, somebody else is using it and they're paying you for the use of it. Yeah, you gotta do some work on it probably every now and then and all that stuff, but for the most part, it's not active income. Unless you are a real estate professional, then it becomes active income. When it's active income, you now are subject to self-employment tax on that income because this is your business, this is what you do for a living. So there's a distinction between those two items. For our purposes of this chapter, we're talking about it from a passive sense. Okay? If it were active, it would go on the Schedule C because it's their business and it's going to be subject to that self-employment tax. Also, rentals, let's see, if that QBI deduction is only going to apply if you have actually, you're actively engaged in that rental activity, okay? That qualified business income deduction. So, example here, Jack is a real estate professional. He also owns and operates a bed and breakfast. So the two aren't necessarily related, but he's in the real estate business. Provides significant services to the renters, has no other trade or business. As such, the activity is traded as a trade or business, not as a rental property. So there's a distinction between those two. Therefore, he reports the rental, lodging, income, and expenses on Schedule C. Any net income from that is going to be subject to self-employment tax. If it were passive, if he wasn't a real estate professional, didn't contribute significant time to to maintaining that rental, then he would report it on Schedule E, and it would not be subject to self-employment tax. There's also farm rental income. We see this a lot in Iowa. Individuals own land and then they rent out land to be farmed by somebody else. That actually has its own schedule. The form 4835 is what's used. Schedule E is for proceeds from real estate, office buildings, rental houses, condominiums, townhomes, and vacation homes. We already went through the Schedule E to take a look at it, so I'm not going to go through all of that. Gross rent is the total rent collected. This would also include advance rentals in the year of receipt, regardless of the rental period covered or the method of accounting period employed. And there's an example down here that we'll take a look at as well. So what they mean by that. December 12, 2021, Della received $7,000 from Philip to cover 6 months of rent. So the rental period is 2022, but the money was actually received in 2021. The payment includes a $1,000 security deposit. Della must include $6,000 as rental income in the tax year 2021. That $1,000 security deposit doesn't have to be included in income unless it turns out that she keeps the security deposit because the renters destroyed the place. Then she would include it as income at the time that she keeps the money. So if they rent it for a couple of years, 2023 rolls around and they move out and she keeps the security deposit, then in 2023, she would include that $1,000 in income at that time, because it's not her income. It's not her money at this point. She's just kind of holding it in trust. Any expenses paid in lieu of rent payments or services that were provided in lieu of rent payments are also included as rental income. So here's an example of that. We've got Bill owns a house. He rents it for $900 a month. During the winter, while he was on vacation, the furnace in that rental failed. So the tenants had to fix it. So they paid $300 to get the furnace fixed. The next month, instead of giving him $900, they were going to pay Bill $600 because they paid $300 that Bill should have paid, right? Well, that whole $900 is still included as income for Bill. It's offset by $300 in repair expenses on the furnace. So it will be in and out for him, but it still has to be included in income. Now he owns a second rental house that also needs repairs. Bill needs to keep up on his repairs. He allows the new tenant to live rent-free for 3 months. In exchange, the tenant is going to complete the necessary repairs. The value of that rent is $1,800, so $600 a month. He's got to include $1,800 in rental income. And then he would take a corresponding deduction for the repairs expense. Again, assuming they are not capital improvements, and that's a distinction that we have to make between expenses and capital improvements. Because remember, if it's a capital improvement, essentially it's an improvement to an asset, that then gets added to the basis. That's one of those adjustments to basis, and gets depreciated over the life of the asset. So we've got to distinguish between what is an expense and what is a capital improvement. Sometimes that line is really hazy as well. So ordinary expense, again, ordinary and necessary type of expenses are the general criteria that we would need to use. So some types of expenses, and these are the ones that are listed on the form, the Schedule E. So we already went through a lot of these. These are the most common types, but there are other types as well. Capital improvements, remember, this is anything that would extend the life of the asset or improve upon the asset. So any types of additions would be considered a capital improvement and therefore would be an asset that we depreciate. Improvements, built-in appliances, so anything that's built in to the building, it's attached. Flooring, upgrading a kitchen, carpeting, heating system, central air, furnace. It's kind of funny because furnaces, you think of them as separate items, but they're actually considered, because they're attached to the house, they're considered to be a capital improvement. Driveways, walkways, fences, retaining walls, so all of that outdoor stuff as well. Any work on the floors or the attic, septic systems, plumbing, water heaters, and then miscellaneous, so any windows or doors, a new roof, that kind of stuff. These are some examples of what would be a capital improvement, and therefore what would need to be added as an asset and depreciated over its life. And remember, you can't use that section 179 with rental assets, and you can't use section 170, or you can't use the bonus depreciation on anything under 20 years or anything over 20 years asset life. So a lot of these would be limited. We'd have to use that maker's depreciation to depreciate them, as opposed to these types of expenses, which we can just expense in full at the time that we incur the expense. So here we've got Brian in Birmingham, Alabama, owns a rental condominium in Destin, Florida. Twice a year he drives to Destin to perform general maintenance on the condo. His mileage and all of the expenses related to that trip would be deductible as travel and transportation costs for the rental. So if you drive to maintain the rental, or you drive to anything related to the rental, you can include those transportation expenses as an ordinary and necessary business expense. General repairs and maintenance are deductible as current expenses. Taxpayer cannot deduct amounts that are capital improvements though. So repairs are expenditures that do not materially add to the value of the property nor appreciably prolong the property's life. So that's kind of the criteria. That's why I can get a little bit of, there can be some gray area, and some of it's based on opinion. Any repairs as part of an extensive remodeling are considered capital improvements. So therefore, if you are remodeling the bathroom, the entire bathroom, and you're gonna keep the sink, because I don't know, maybe some historic sink, but you have to repair a crack in the sink. Well, the repairing of the crack in the sink, because it's part of an overall remodeling, would be considered a capital improvement. Let's see. There are some expense that are capital improvements that you can expense immediately, but they are very limited. So they are going to be limited to 2% of the building's adjusted basis or $10,000, whichever is higher between those two. But you have to have average rental receipts of under 10 million. That's probably not a problem for most landlords. And properties with a basis of more than $1 million are not eligible. That's probably the more limiting factor. All right, so we depreciate again if it's we depreciate property if it is residential. It's depreciated over 27.5 years. If it's commercial, it's depreciated over 39 years. But oftentimes we have different components within a rental property, right? So we don't have just a rental property, a building. Well, first off, we also have land, right? Usually as part of a rental property. So let's just use let's just use a residential rental as an example. We need to separate out the different components of the rental property. So let's just say we bought a home to be used as a rental, and we paid $200,000 for it. Well, land is not depreciable. So if land was part of this purchase, if it was a condo, that'd be a different story. Condos don't have land, but this is a home. It has land attached to it. You have to separate out the value of the land from the purchase price. Normally what you would do is probably look at the assessor's page. If you go on a county assessor's page and look up a piece of property, it will separate out the value of land from the value of the rest of the building. Normally, what you pay for it is probably not going to be what the assessed value is, but you can use a percentage. So let's just say we went online and we looked at the valuation and we determined that 25% of this is land. Well, all right, so we've got to take out $50,000 because we can't depreciate this, right? So now our building value is $150,000. This is the amount that we can depreciate. This is not depreciable. We still put it on the tax return because someday when we sell this house, it's going to be part of the basis of the sale price. But this is not. So you got to allocate, you got to separate that out. So this is the building. But as part of that building, we've got a kitchen in our home. That kitchen has appliances in the home, right? The value of the appliances, let's say we valued those at $5,000. And then we've also got carpet that is valued at $10,000. And we've got, on that land, we've also got some landscaping, okay? Which is valued at $15,000. All right, so now what we've done is we've separated out all the different components of that property. So we gotta separate, to figure out the amount of the building, now we've gotta separate these from that building. So this is what, 30,000? So the building itself is 120,000. These have different, so the building is gonna be depreciated over 27.5 years. That landscaping is gonna be depreciated over 15 years. The carpeting over 5 years, the appliances over 5 years. So by separating this out, we've essentially increased our depreciation deduction in the early years by shortening the period that $30,000 of that value is depreciated by. The example here shows kind of the same thing, how this all works. And yes, you're allowed to do that. You separate it out. So here we've got Alan. So Alan and Cherie, you know the Masters. They purchased a furnished beach house in San Clemente, California for $1.364 million, June 1st, 2021. The land was valued at $700,000. The furniture, $15,000. Appliances, $3,000. Carpet, $4,000. Landscaping, $8,000. The Masters rent the house full time. If they depreciate the house as a single lump sum, so $664,000 is what's left, which is the $1.364 million minus the $700,000 for land, they would get a depreciation deduction of $13,081. If, however, they pull out those different components and depreciate those items using maker's depreciation, their total depreciation deduction now jumps to $17,290. Now, of course, this is only going to be in the early years, right? Because we're kind of front loading all of that depreciation for those individual items in there. But if you think about it, how often are you going to replace carpet? Probably pretty frequently on the rental property. Appliances will have to be replaced as well. Landscaping has to be updated. So all of those assets are eventually going to be updated, and then when you spend money updating those assets, you'll get to depreciate the new assets as well. Okay? So it looks like the Masters, you're gonna have a Shoebox to Software assignment with regard to rental income for the Masters here. And then there's what it should look like. So there is going to be a depreciation component to it. FYI, heads up. Alright, so again, section 179 deduction cannot be claimed for property, for rental property. You can use 100% bonus, but remember there are limitations. It's got to be depreciated over, was it 20 years or less than 20 years? And there are some limitations with regard to losses on rental properties. Those losses are covered in chapter 13, and we don't cover chapter 13 in this class because we just don't have time. But if you're interested, feel free to take a look at what those passive loss rules are. They're generally, you said, if your income, I don't know if it's increased over 150. It used to be if your adjusted gross income or modified adjusted gross income was over 150,000, then you really couldn't. You were limited to like